Hi guys, how's it going? It's Antotom Chagi and welcome back to my YouTube channel. In today's video, we're going to be investing in the US stock market and also touch a bit on the anticipated stock market crash. I did say previously that I am building my portfolio in the US stock market, and today I am officially starting that journey where I focus on this portfolio. And you know what? Either you invest in the Australian stock market, United Kingdom stock market, South African stock market, the US stock market, the principles are the same. The very same principles you followed when you started building your South African portfolio is the very same principle you're going to follow when you build portfolio in foreign stock markets. Because investing principles are the same, and once you grab them, you can build a solid portfolio anywhere. Before we get deep into this video, please note that none of my videos constitute as financial advice. I am not a financial advisor. So as of today, I only have 11,800 invested in the US, and this is almost half what I have in my ZAR portfolio. This is because when I first got exposed to investing, I started with companies that I am familiar with, and in this case it's South African companies. So when I started investing, I played it local and invested in companies that I am comfortable with, that I know that I have seen before. Because with foreign countries and companies, I was like, who is Amazon, who is Google, who is Netflix? I have never seen them. I just know that they exist, but I never got to fully expose myself to those companies. And also sticking to the idea that you need to buy something that you know, companies where you buy from, that was kind of like stuck in my head. And that's why for the longest time I focused on South African markets, because I was not so comfortable with foreign companies. And like I say, with Netflix, I was like, okay, but what if I wake up one day and Netflix is not there and I've never even seen it? What if I lose my money? So I was very much skeptical, because I just wanted to stick to what I knew and stick to what was familiar. And the issue here was that I was a complete beginner, and like I say, I wanted to stick to what I knew until I invested so much of my time to understand the investing game. And that's when I actually got to realize that principles that I followed to build a South African based portfolio is the very same principles that I can use to build a portfolio anywhere. And I have finally got to realize that the investing game does not change. It doesn't matter who you are and where you're from. And obviously I'm referring to fundamental analysis. This applies to all companies, and it's because a principle is a principle and it does not change. So over time I actually got to realize that, oh, it's the same, and that actually gave me the confidence that I needed to invest in foreign countries. So if you did not know, the US economy is one of the largest economies in the world, and when you invest in American countries, you get to be exposed to world-class companies that have achieved a level of excellence that is recognized globally. And some of these companies are Amazon, Apple, Google. All of these are American companies. And what needs to be understood is that the bigger the company, the better. And if it's profitable, has a strong balance sheet, has a positive cash flow, it's even great. So if you look at my portfolio, I only have $642.12 invested, and I'm up 0.89%. And if you look at my holdings, with everything else, I am on green, and it is only Nvidia actually that is weighing my portfolio down. And the thing is, it hasn't been long since I started investing in the US, actually building my portfolio, and timing the market is everything, because over time the market gets to go up. So if there's a secret to successful investing, is that you need to invest for long term, because this creates a stable portfolio for a long period of time to generate higher returns. To actually emphasize on this, let's go back and look at my S&P 500 in my tax-free savings account. So with the S&P from this account, I am up 17.49%, and we'll check in the US because it is up 1.64%. So we need to get in the habit of buying and holding for longer term. The market in the short term will go up and down, and that's what the market does all the time. But in the long term, you will get to see good results. So with this one in the USD account, I just bought it probably a couple of months ago, and like I say, that time in the market is everything. Understanding that I only started buying this one a couple of months ago, that's why I'm only up 1.64%. And looking at the one in my TFSA, I'm up almost 18%. That's what happens when you invest for long term. So if we are going to look at my portfolio structure, I have 72% in ETFs and only 19.2% in equities. And I have $53.33 funds to invest, and that's what we will be investing in this video. And I'm still following my strategy to have a lot of money invested in growth ETFs and companies, and then a small portion in dividends, obviously for the reasons that there's money in growth investing. We just saw that the S&P ETF in my TFSA is up 20%, and how many good companies can give you a 20% dividend yield and let it be sustainable and consistent. So for the sake of making money and accelerating my wealth, I will be focusing on growth. So I have 2 growth ETFs and 1 growth company and 2 dividend holdings. So the first holding I'm going to invest in is this JP Morgan Equity Premier Income, which is also known as the JP ETF. And this ETF pays dividends every month, which is why I bought it, and I am going to invest only $7. And the market is closed, so I'm going to buy it open. So I'll also put the same amount in Realty Income. This company also pays dividends every single month. And honestly, I'm not looking to add more dividend focused holdings because, like I say, I don't want my portfolio to have a lot of dividend ETFs or companies, because I am focusing on growth, because that's where most money is. So I'm going to click on buy more and buy $7 worth of shares. And the next holding I'm going to buy shares in is Nvidia. This is an individual company, and they're going to publish their 4th quarter earnings, and honestly, people are really waiting for that. And I think by the time that I have this video uploaded, they would have published the earnings. So with this one, I'm only going to buy $10 worth of shares. And I have $24 left, and I am going to invest this equally into the total US stock market ETF and the S&P 500. So I'm going to start with the US total stock. So I'm going to invest $14, and the remaining is going to go to the S&P 500. So before I invest the remaining amount into the S&P and also talk a bit about the stock market crash, the anticipated one, let me actually clear why I have these 2 of the same ETFs in the portfolio. So I have the S&P in my TFSA, and understanding that in the TFSA I cannot just invest as much money as I like. So I have it there. However, there is a limit of me only investing 36,000 in 12 months. So meaning that if I get to max out my TFSA, let's say within the first 6 months of the tax year, I will no longer be able to invest in the TFSA, meaning that I won't be able to buy any more of the S&P in that account. So if you think about it, that is quite limiting, because if I say that I am stopping and not having 2 or more of the same ETFs in my portfolio, I'll be missing out on potential returns of that ETF. And understanding that the S&P is the gold actually, right? And this is an ETF that is used to measure the US stock market. And also understanding that when you invest in such diversified portfolio, you actually get great returns. So understanding that about the S&P, what made sense to me, and also considering the fact that the TFSA has its own limitations, it made sense to me to have it in my USD account as well, because in that account I can only invest so much. And the last thing that I'm going to stick with is the fact that I'm avoiding overlapping or having the same ETFs in the portfolio. So with the TFSA, if there is that limitation, then I cannot also limit myself. That is why I have 2 of the same ETFs in the USD account and in the TFSA. And also, if we are going to compare returns, if we look at the 1-year movement of this ETF in the USD account, it is up 25.62%. And in my TFSA, it is up only 12.8%. 11%. So these are the things that you can actually consider when you think about having two of the same ETFs in your portfolio. And to just be honest, when I started investing in the TFSA, obviously I did not have in mind that there is the USD that I would want to invest in. I did not care about it like that. So I just focused on my TFSA, and I was only focused on the returns that are displayed on the ETFs in my TFSA. I had no idea that this can actually move a bit different to how the one in the USD account is moving. I'm just realizing it now when I'm starting to focus on my USD portfolio. And one thing about me, if you know, I'm always about the maximum returns. If something can give me the most returns that it can ever give me, then I am all in. But that does not mean that I am going to abandon my S&P in my TFSA and focus in this one. I obviously want to take advantage of the tax benefits that we have. So I will also focus on that one until I max out my TFSA and then move to this one. So the remaining amounts to invest, I have $15.33. So I am just going to put all of it in. So now back to the stock market crash issue. Like I said, that the S&P is used to measure the US stock market. So as I say that the S&P is used to measure the USA stock market. So if you see your investment in the S&P 500 declining, that is because the US stock market is taking a knock. Now, Warren Buffett's stock tracker was published, and he sold 100% of his shares in the S&P 500. And this is actually very much concerning because Warren Buffett is so influential and people copy his moves. And when he exits the S&P the way that he did by selling 100% of his shares, people actually go into panic because they're asking themselves, oh, what is going to happen? What does he know that they don't know? And obviously the influence is because this is somebody who has seen a huge success investing. So I guess he is considered to be that guy. And then now on the other hand, that the stock market is anticipated. And if you are investing in the US stock market, investing in ETFs like your S&P 500, you are going to be affected should the stock market crash. The thing is, this is just speculation, right? When exactly is it going to crash? Nobody knows, but I guess your S&P ETF is going to let you know. And obviously your portfolio is going to lose value, but remember that you only lose money when you sell. And we all know that there is this famous saying that when others are fearful, be greedy, and when others are greedy, be fearful. So in a time like this where a stock market is anticipated, a lot of people actually get to be so fearful and they think of selling their investments, selling their shares, and this is a time where people get to make a lot of money. When they say that the stock market is going to make people billionaires or makes people billionaires, it's actually during times like this. So what you are going to do is actually up to you, to decide if whether you are going to be fearful when others are greedy, or you are going to be greedy when others are fearful. And also understanding that the market in the long run goes up, and the S&P being one of the diversified ETF and used as a benchmark to measure the US stock market. So actually it's like the stock market, the US stock market, right? So an ETF like this, and factoring in the fact that the market goes up in the long term, I am not going to sell my shares in this ETF. What I'm going to do instead is I am going to keep on investing more. And when the market takes a knock, causing dips, I am going to put in more money. Because when it gets to go up again, then I'm going to realize more returns. And obviously in times like this, the rent cost average is going to work perfectly in your favor. When the market goes down, like I say, that we get to see dips, right? So you might find that there will be a dip here, a dip here, a dip here. So rent cost averaging is going to work absolutely in your favor than when you just put in a lump sum of money, because you never know how much more of a knock is it going to take. What if you put in your lump sum when the share price is, let's say, $100, and then the coming week again it declines to maybe $50, right? You're going to wish that, or you could have waited, but the honest truth is you are never gonna know. So rent cost averaging actually comes with benefits, and this is one of its benefits and why we actually do it. So as for me, I am waiting for the stock market crash. Can it crash, please, very quick? Because that is where most money is made. And also another thing that I've actually got to realize is that such news are very much hyped up, right? And they do understand that emotions go into investing. And a lot of people get to be so fearful, and when people get to be so fearful and they take their money out of the stock market, the ones that have the most money to invest, where they actually keep cash so that when times like this happen, they can put in more cash, that when the market goes up again, they're going to realize more returns. That is what they do. They are causing this panic so that somebody like you and I, an average investor, can panic and think that, oh, they're going to lose all of their money and what is going to happen to their wealth building journey. But most times, experts, that's what they do, to cause a panic so you can exit, and then they enter and then they get most money. So what I can just say is keep calm, and if you have more cash, if the stock market crashes, when it crashes, then you can just put in more money and position yourself actually to get the most returns. And with that being said, we have come to the end of this video. I really hope that you have enjoyed it and it has kind of opened your eyes and put you at ease with what you can do should the stock market crashes. And also, if you have not started building your portfolio in the US stock market, please get on it, because these companies in largest economies do give good returns. You can go check out your Apple, your Google, and check how the returns have been over the years, and you actually get to see that, oh, okay, they do have good returns. And like I've said before, that they have achieved a level of excellence, and it's undeniable that these are big companies. So maybe you need to consider that. Once again, thank you so much for watching. I will see you in my next video. Bye.